Hello, this is the walkthrough problem for scenario analysis. If you would like to follow along with this, you can download the Excel file. You will see that there is the notes section, which is what we are on right now, as well as the problems that we'll be going through, as well as their solutions. So if you need to reference those, you can. In this video, we'll be going over net present value, IRR, profit index, and payback period. We'll also be looking at if you have enough capital or not, which will be the first questions on here. So problem number one is a question of whether or not you have enough capital without going out to go get leverage. So you've got in Word that you have a potential investment opportunity that has a price of $2 million that you would like to invest in. You currently have $500,000 in cash and cash equivalents, as well as $100,000 in 10-year bonds. So without the use of leverage, also known as debt, would you have enough capital to invest in the opportunity? So without going too far in depth, we can see that the investment costs $2 million, but we only have $500,000. These 10-year bonds we can't touch for 10 years. So without the use of leverage, we will simply not be able to afford these. So question number two, Trevor Inc. is a tractor manufacturer that assembles tractors for other companies on contract. Trevor Inc. would like to produce its own tractors and assemble them in-house. This proposed project would cost a total of $90 million. This includes all the costs needed to start the production of their own tractors. Trevor Inc. currently has $10 million in cash and cash equivalents, $5 million in long-term bonds, which are 10 years, $2 million in short-term bonds, which are 3 months, and $110 million in current assets, which include their current inventories. So without the use of leverage debt, would they have enough to buy this proposed? Well, they have enough for this proposed project. So we can see that the cost is $90 million, but without going into anything else, we can see that $100 million is sitting on their books in cash and cash equivalents. So therefore, that is a big yes, they can. So a project should be rejected if NPV is blank and accepted if it's blank. So NPV, if we go back to this note section, is the benefits minus the cost. So if it's a 0, then the benefits equaled the cost. If it's more than 0, then we can assume that there was more benefits than cost, and likewise, if it's a negative number, then the costs were greater than the benefits. So with that idea in mind, we can go ahead and look down the list of options here. So anything less than 0, so a project should be rejected if it is less than 0. So this gives us this one answer right here. So we're going to go ahead and bold this. So option B is your best answer here. So when NPV is greater than 0, so we're getting more benefits than costs, the price index will be what? So when looking at this, we would expect from the video that you watched previously that from the chart that we had on there, we'd see that we would have a price index greater than 1. So when NPV is less than 0, the price index will be what? So for number 5, we would guess that it would be less than 1. So it's only 1, equal to 1, less than 1. So those are the only options. These are the ones with 1. So NPV is greater than 0. It pivots around 0. Price index pivots around 1. So if NPV is equal to 0, so our costs are equal to our benefits, price index will be what? We would assume that this will be equal to 1. So number 6. Oh, I missed it. All right, number 7, when IRR is equal to the rate of return, so the required rate of return, we need to select one of these. So number 7, so if our required return is equal to the MPV, then we got exactly what we thought we wanted. If it's anything less than that, we didn't get what we wanted. If it's more than that, then we got more benefits than our costs. So we can see that that one's already correct. So MPV less than 0, that doesn't make any sense because that wouldn't equal our rate of return. MPV is greater, we would expect IRR to be bigger. And then as for the other ones, MPV equals 0, and so on. So when IRR is greater than the rate of return, we need to select one. So if it's greater than the rate of return, we would expect that MPV is greater than 0 because we're getting more benefits than the costs. And then for number 9, so if IRR is less than the rate of return, we would expect a MPV less than 0 because we're spending more and we're not getting the return that we require. All right, so number 10, we are going to be working on how to calculate MPV, the price index, as well as IRR and payback period. So luckily for us, we're on Excel, so we can type in MPV and we're given a rate. So in this proposed problem, so suppose you are given the following data for a proposed project. The project will cost $500 and given a rate of return of 12 for the firm. So like it says up here, our rate is going to be 12%. And then our values, so using MPV function, the MPV doesn't understand the concept of the cost. So we're just going to take these first couple right here, the cash flows coming in, and then we can close that out. But we got to remember the cost because it's net present value. So we're going to add our $500 because it's on there as a negative, and we'll get $115 net present value positive. So we're getting more back than we costed. So we have a positive net present value. Our price index, if we go back to here, we can see that our price index is our present value of our cash flows divided by the present value of the cost. So in order to calculate the price index, we need to take some present values first. So by putting a negative in front of the present value function in Excel, we can do this because it will give us a positive. So our rate is 12%. Our periods per year is 3 because this project has a lifespan of 3 years. We do not have a payment. Our future value is going to be a sum of the future cash flows. And then we got to divide this by the cost. So at time 0, our costs are at their present value. So we can do those as they are stated. We just have to put a negative in front because it's stated as a negative in here. And we should get 1.14. So our profit index is above 1, which is good because our net present value is greater than 0. IRR, luckily we are in Excel again, and IRR is a function. All we have to do is give it the values. IRR understands time value of 0, so our cost is in the calculation it does for us, and we get 23% here. For the next number, the payback period, we got to go back to the note sheet, and we'll see that it is the sum of the costs divided by the future cash flows. So our cost, what it cost us, the benefits, and the number of periods. So we're going to go equals. So what did it cost us first? So we got to get our $500, and we got to divide that by the sum. We should probably put a parenthesis because there's a sub fraction here. So we got to sum up our future cash flows. All right. And then we got to divide by 4 because there's 4 periods here. Well, there's 3 actually. Sorry. And then we get a 1.85. So we'll expect our money to be paid back in about almost 2 periods. So by this second period, it should be paid off.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.